Are there examples where this has played out before, or are we in a very unique situation in that this is truly global? I don't know 2008 was a global crisis, but that kind of doesn't feel like such a bad situation anymore. I mean, the US printed 500 billion in the last 2 weeks. I mean, it was 800 billion bailout for 2008. So it feels like we're in a very extreme scenario.
I would say one is that the more connected the world is, the more it's going to be a worldwide issue versus local issues. People that have seen the podcast before probably know that I often compare the 2010s to the 1930s and the 2020s to the 1940s. So there are a lot of elements back then. What's new this time is that most of these kind of long-term debt cycle or institutional cleansing cycle things that we go through, fourth turning, whatever you want to call it, usually there's a changeover in the type of money we use. You go from, say, free banking to central banking with a gold underlay. Then you go to another central banking model where you don't even have a gold underlay anymore. And what we've never done before is go through one of these cycles when we were fiat currency going into it. So what comes out, right? We've never gone in this gigantic fiat currency global cycle, have a whole sovereign debt crisis on a global scale, and then see what's on the other side of that. That's new.
And some people listening can be like, well, it's Bitcoin, but I don't think we're there yet.
There's no precise way to tell what the tipping point is, but when high inflation becomes hyperinflation, that's usually the moment in which the crisis of confidence really spreads beyond, the small circle of people who, may have been sounding the alarm about it all along. I'm reminded of Weimar Germany when, there was high inflation after they went off the gold standard in 1914. But hyperinflation didn't really hit until the end of 1922, 23. And that was the point at which farmers stopped accepting the Reichsmark in compensation for their labor, and the country was put on the verge of starvation. And so it's that collapse when, I was alluding to the state theory of money earlier, money as law, or the thing that is decreed by the state as legal tender, when people just stop accepting it, that's the point at which there's crisis.
And I would add that it's not even just hyperinflation that can do it. It's the perception of the loss of control.
Right.
And so, for example, there are a lot of developing countries today where they're not in, say, outright hyperinflation. Yeah. They might just have double-digit inflation on a recurring, regular basis. It's like a background part of life. And there's no expectation that they're going to get it under control. And that's kind of the world. That's historically a developing market phenomenon. Mm-hmm. And you can get that kind of situation in the developed world if this is left unchecked. I think that's kind of on the train we're going for, is that you can call for kind of a central bank losing control in the sense that there becomes no clear way where they can get it back down to their kind of prior baseline of money supply growth and price level changes and things like that, where there's too much public debt for them to tighten the way they want to. And then the challenge is that when you have a lot of public debt, interest rates start losing their effect. They become more complicated tools to try to slow down inflation compared to when you have lower public debt levels and higher private debt levels. And so when I get questions on hyperinflation stuff, I kind of put that aside and I say, we don't have to be there for this to be a problem. Like if you look at right now, the market still generally thinks the Fed can get the current situation under control. And maybe for a few years they can, right? It's, you can cyclically get it under control potentially. So right now, whenever you see kind of a higher inflation print than expected, you'll see the dollar strengthen, and you'll see other, because they say, well, now the Fed's got to get even tighter, right? Because they're going to get this, right? Mm-hmm. And so that's the current kind of market reaction for how this is going. And when you go through the looking glass is when the market realizes they actually don't have control. Right. And we're not there yet, but I think we're on this kind of either multi-month or probably more realistically multi-year process of getting to that point.
And so are you basically saying particularly high double-digit inflation is entirely within the realm of possibility within Western, liberal democracies, within the UK, within Europe, within the US, in the nearer term? When I say near term, next few years?
I would say within the 2020s, I think. Next few years, perhaps. I think that what I look for is the ingredients that can lead to that. and I then judge the probability that those ingredients are building. So one would be energy security.
Yeah.
That's obviously in a dangerous spot right now. And sometimes the problem goes away, but the structural issue's still there. So one would be energy security. And then the other one would be looking at the size of deficits, wondering how they're going to be financed, looking for any attempts to kind of improve the deficits, and then looking at the overall public debt to GDP ratios, because that's an indicator.
135%.
Exactly.
I'll never forget that.
Yeah. And that's an indicator that starts to become relevant, because when you get to that very high level and you raise rates, at the same time as you're pushing down the private sector by raising those rates, you're also greatly increasing the deficits. And so if you imagine two numbers, if you imagine the US in the 1970s, the US had 30% debt to GDP, and most of the money creation was happening in the private sector, not all of it, but a lot of it. And when Volcker raised rates very high in that period, it did two things. One, it slowed down bank lending, because now it's a much higher hurdle rate to borrow. But it also would increase the deficit to some extent, because you're paying higher interest on your debt. But because that was so small, the negative impact on the private sector was much larger, meaning that those rate hikes were disinflationary. The problem is, if you fast forward, let's even go past the current, let's go to Japan. If you have 250% debt to GDP and you have pretty slow bank lending, almost all the money creation is really coming from the government deficits, the monetization of those deficits. And so if you raise rates, you actually risk accelerating money supply growth, because when you raise rates, the public interest expense will balloon significantly, because you're doing it from a 250% debt to GDP base, whereas you're not going to impact private sector lending much, because that's already small relative to that. So that's the problem, is that as you get more and more debt on the public level, interest rates become a more mixed tool for addressing inflation, and eventually can become literally a negative tool for dealing with it.
So is the mistake here not letting things break? Things should be allowed to break, and break at their natural kind of moment in time, rather than kind of like this kick and can, because essentially they keep blowing up the balloon.
Yeah, and really I would describe the moment as, if you look at the global financial crisis, and this also happened in the 1930s, which is you had decades and decades of building broad money compared to base money. And broad money is an IOU for base money, a fractionally reserved IOU. And when you get higher and higher debt, and then interest rates go all the way to zero, and things start to break, there's one of two things that's going to happen. Either those claims are going to start collapsing down closer to the base money, big deflationary collapse, or they're going to print a lot more base money and make most of those broader claims money good.
Money good, but not purchasing power good.
Not purchasing power good.
Which means inflation.
Yes. Yeah. And what they did back in 2009, 2008, is they radically increased the base money, and they've been doing it ever since, to never let broad money collapse by any significant amount.